Save your money is actually such terrible advice. I know our parents meant well when they told us to save our money, but it's so bad. What I'm going to tell you in this video is so catastrophically important for you to understand if you have any hopes of ever reaching financial freedom in your lifetime. I don't want to call it a conspiracy because no one's exactly hiding it from you, but there's definitely no one that's incentivized to teach you this stuff. You will not learn this in school. So you probably already know that inflation is pretty much a fact of life. At one point, money was pegged to gold, so it was impossible to just very simply create more of it. But once it was unpegged at the beginning of the 1970s, it became very simple to just print more money. And when they print money, the money in your pocket, although it's the same numerical amount, it becomes now a smaller portion of the total global money supply, and so now is worth less. It's basically a silent tax that no one gets to vote on. Just take a look for yourself. This table shows you how much money is circulating within the United States system per individual in America. So in 1970, for every person that made up the population of America, there was $2,900 of money circulating within the United States money supply system. Since then, the money supply from all the money printing has increased massively. Meanwhile, the population growth has definitely not kept up. This has resulted in today, right now in 2020, there being just under $57,000 per person circulating within America. And here's what that means for you. If your portion of the total money supply remains as is, while the total money supply increases, then the value of your portion of the total decreases because you now own less of the total, even though the numerical amount that you have has remained exactly the same. They tell us that inflation is 1 to 3% per year, but how could that be? When you look at it from this perspective of money supply circulating within the system per individual, it becomes apparent that it's much closer to 6% per year. And still, that's if you're even averaging it out over 50 years. Money supply has been increasing at a much more rapid rate more recently than it did 20, 30, or 40 years ago. So inflation lately is probably even much higher than even that, which is very bad if you have money sitting in a savings account. Putting your money into a savings account earning 1 or 2% per year because it's the safe thing to do is actually going to result in the purchasing power of your money being destroyed over time. It's annoying, right? Because I've worked hard for my money, and I know you've worked hard for your money too, and I know you're going to work hard for that next dollar you earn as well. And I hate to see the purchasing power of your money just evaporate right out from under you. So I'm not just going to tell you what the problem is, I'm going to give you the solution as well. So here's the solution. Instead of keeping your money in a savings account where you're going to be consistently getting robbed of your purchasing power year after year, use that money instead to buy real assets. I'm talking about real assets that retain their value as the value of money itself is just being destroyed. Again, it's no secret that the value of money is being destroyed over time. It's why billionaire Ray Dalio says cash is trash. Although I'm not the biggest fan of Ray Dalio, he's right. Cash is trash, and that means savings account money as well. I'm going to mention 2 of these real assets that I think are the easiest and best ways to hedge against inflation. And the first one is owning a piece of a business, or in other words, having an ownership stake in a business. And the easiest way to do this is through buying stock. This is a great way in my opinion. Buying real estate is also a great way to do this, and it's possibly even an easier way for most people to go, simply just because it's going to be easier to not accidentally overpay for your real estate. Whereas with stocks, it's very easy to accidentally overpay. When it comes to real estate, there's also some other advantages that I'm going to explain in just a minute. Nonetheless, these are called inflation hedging assets. And here's how it works. When it comes to buying a business, first of all, and whether that's again buying an entire business or just owning a piece of a business through buying shares of stock, over time, essentially what happens is businesses will continue to raise their prices on the goods and services that they sell, at least enough to keep up with inflation. And because a business's value is based on how much cash it can and will generate, it means that the value of that business will increase at a very similar rates to those increasing earnings. So even if a business were to sell the exact same amount of units, but continue to raise its prices to at least keep up with inflation, then the value of the business will continue to grow in the same proportion. And again, even without any increase in the actual amount of goods and services that it's selling. And if it's a public company with its ownership having been divided up into however many pieces that are being freely traded on the stock market, well, the intrinsic value on a per share basis will also increase proportionately as well over time. So owning a business or a piece of a business is a great way to hedge against inflation and potentially even get a return as well. Some businesses actually even benefit from inflation much more than the other businesses do. And that actually leads me directly into my point about real estate. A lot of fortunes have been made with real estate for this reason that I'm about to share. When it comes to real estate, we have mortgages, which allow us to leverage up and buy more real estate than we could if we were just paying straight cash. Through leverage, like a mortgage, you can control a larger asset and enjoy the value appreciation of a larger asset while using a lesser amount of personal invested capital. So real estate has this advantage going for it just because it's a lot easier to use leverage when it comes to buying real estate, because it's believed to be more safe than something like stocks. So banks will be willing to put up the cash for you and give you that mortgage so you can buy that house, right? They're much less likely to give you money so you can go out and buy stocks, just because stocks are believed to be much more risky. Leverage, by the way, in any form is very dangerous, so you just got to be careful that you don't overextend yourself. There's been just as many people completely and utterly destroyed by leverage as there has been by people that have made fortunes using leverage. Just be careful. I want to leave you with a little thought experiment. Okay, so let's imagine that you buy a home with the purchase price of $500,000 and using $100,000 for down payment. So you get a mortgage of $400,000. And we're gonna say that the value of this new property of yours increases by 5% per year. And we're gonna also say that that is also the rate of inflation. So all you're doing is just keeping up with inflation, meaning that in 10 years from now, whatever the property's worth then is the equivalent to the purchasing power that $500,000 has today. So all you did was hedge against inflation and retain your purchasing power for 10 years. You didn't grow your purchasing power, all you did was simply just protect it. Okay, so now let's say that your mortgage rate on your $400,000 mortgage is 3%. And for simplicity purposes, we're gonna say that you're able to just make interest-only payments, which would mean that your monthly interest-only payment on a $400,000 mortgage at 3% would be $1,000 per month. So that's per month, but per year, that would be $12,000. And again, your mortgage balance is just gonna remain the exact same, unchanged, a consistent $400,000. So in 10 years from now, your mortgage balance will still be $400,000. You've only just made interest-only payments and nothing towards the principal. However, when we look forward 10 years, we realize that inflation has actually taken its effect on that $400,000 mortgage as well. Although numerically, it is still just $400,000 of debt. If we're using the same rate of inflation, the 5% rate, that $400,000 has about the same value as just $245,000 does in terms of present value today. Let that sink in. So although the quoted rate on your mortgage was 3%, in reality, in terms of real buying power value, the true rate on your mortgage was actually less than 0%. You got paid to carry that mortgage. There's definitely a few other factors that could go into this little thought experiment here if we wanted to take this to its fullest conclusion. However, the main takeaways I want to leave you with for this video are: 1, if you don't use your cash to buy real assets that at least keep up with inflation, then inflation is going to consistently rob you of your money from you year after year. Number 2, the best assets to buy to hedge against inflation are real estate and stocks. And number 3 is that inflation can actually be your friend if you're a mortgage holder or debt holder, assuming that that mortgage or debt is at an acceptable rate, because inflation will continue to have its effect on this money as well and erode away at the value of it over time, even if the numerical amount of the mortgage balance remains the same. Please remember that I'm not a financial advisor and this isn't financial advice. I'm just someone who's always loved money and loves to think about money and loves to talk about money. So please just make sure you do your own critical thinking, your own decision making, and do your own due diligence before you take any action on anything that I've ever put out there anywhere.
You've got a few choices. You can go with fixed dollars one way or another, your money market funds, bonds, or anything else. That's guaranteed to not work. It's so funny. I mean, it's funny for the people to do it, but when you put your money in something that's supposedly safe, if you put your money in a money market fund or treasury bills now, that is guaranteed to go south. You can buy farms, you can buy apartment houses, duplexes, various kinds of real estate, or you can buy good businesses. Or you can buy little pieces of good businesses. Now, among that choice, good businesses are the cheapest by some margin.
Inflation, Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency.